Hey, what's up, everybody? Welcome to the live stream, or if you're watching this at a later date, it'll be known as Keith Condensed. And today, what I wanted to do was tackle a question that I got on a video that I actually posted earlier on a Keith Condensed video. It was called How I'm Handling, or How I Am basically setting up my account for a possible 30% pullback in the market. That doesn't mean that there is going to be a 30% pullback. That's just how I'm setting up my account, just in case something like that were to happen, at least for maybe the next year to 2 years. However, that might not fit your strategy. That might not be what you believe. That might not be your opinion. And so you're acting differently. By all means, there's nothing wrong with that. I'm not saying that I am right. I'm not saying that you are right. I'm just saying that we all have different opinions on the way that we think the market can go. And so it's to our best judgment to play the positions that we think are going to put us with our best foot forward, pretty much. So this is my opinion, so take it for what it is. Don't buy or sell based upon how I think the market will turn out. So anyways, let's go ahead and jump into it. This question comes from Julian Kirby. Ask, could you share your opinion on the different monthly dividend paying ETFs on Stash? I do actually already have a video where I cover, I think, 4 different bond investments that are on Stash, but I didn't have a video where I updated and talked about the new 3 that they add, which is like big business bonds, bonds worldwide, and then I believe that there's another one like match the market or something like that. But as far as they go, my opinion on them, for me personally, the one that I like the most is Park My Cash, and that's because it is pretty much short-term bonds. It doesn't go anywhere. So I use it actually more just to kind of get a little bit more interest than I would by having my cash just sit there in the cash balance. And so that's where I've been putting my money for now to get that up to 25%. However, there are other good ones out there. Some of them are going to get you better returns, and some of them aren't going to get you better returns because of the way that the market is. If you're looking for like diversity, I think the international, I totally put my hair up there. I'm trying to go with the video, but the video is opposite. But if you're trying to get international exposure, worldwide bonds might be a good one for you to look at. Also, if you're looking to maybe get a bigger or better return, big business bonds is probably going to pay you a higher percent return than, for instance, U.S. Treasury bonds, also known as Uncle Sam, on Stash, just because that's the nature of the beast. Typically, when you have more risk, they pay a higher percent interest rate. That's the same thing that goes with anything. If you have an 18-year-old that walks in to a bank and says, hey, I would like to get a credit card, they would be like, okay, well, how much do you make, blah, 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 this and that. Okay, well, we can go ahead and give you a credit card at 24%. You know what I'm saying? Where if you had someone who had already had a credit card and a lot less risk, maybe has had a steady job for the last 20 years, also has a pension that's coming in and a second retirement, and has a lot of equity and assets, and they're like, hey, you know what, I'd like to get a credit card here. They're probably going to charge them the lowest rate, which would be a 10, 11%, something around there. So the bank also does that as well with looking at risk when they go to give you a loan. Basically what you're doing with bonds is you're saying, hey, look, I'll loan you this money. In return for that, I expect interest plus the principal. So I expect the money that I paid you. So for instance, if I said, here's $30 and I expect a 10% return on that, here's $30, I expect the $30 back plus $3 additional back to my pocket. So basically that's all you're doing. Bonds, loans, same kind of idea, concept. With ETFs, it's going to be a little different because you're not specifically going and just buying the actual bond and holding them. Those ETFs do kind of trade and that kind of stuff. So for instance, where you can go buy actual U.S. Treasury bonds through, I believe it's treasury.com or something like that, or treasury.gov, my bad. And you can just buy them flat out, like a 5-year Treasury bond or whatever. Basically what that says is, hey, I will give you whatever, $100, and in return, I expect that $100 back in 5 years, plus the interest on that, which whatever the APR is that you decide on, or whatever they're selling the actual bond at, is the case. And so the way that those fluctuate, and I touched on this in another video as well, is by rising interest rates. So when the feds go and raise interest rates, say they raise it from 1.5% to 2%. Well, that bond that you had locked in at 1.5% is no longer worth the bond that is, it's no longer worth the same amount as a bond that's selling at $100 at 2%. You know what I mean? There's going to be a little bit of price drop on that 1.5%. But that's more or less a real brief overview of each and every, like, well, first, real brief overview of bonds in general. And as far as like my opinion on each of them, I can tell you which one I've been putting a lot of my money in. Eventually, I'll probably own every single one of them. But right now, my strategy is to focus in on park my cash. Diversity-wise, I think that if you're looking at maybe owning 2 different bond funds, adding bonds worldwide might be a good idea, because it, again, exposes you internationally to those international bonds and doesn't just keep it locally here in the States. And then if you're like, you know what, I don't really want to do anything with bonds with these specific ETFs, I would look into a mix. All the mixes have exposure to bonds. So that goes from the long-term mix all the way down to the conservative mix. The long-term mix is going to expose you about 20% into bonds. It's going to expose you 80% equities, 20% bonds. The aggressive mix is doing 60% equities, 40% bonds. The moderate mix does 40% equities, 60% bonds. Conservative mix does 20% equities, 80% bonds. So if you're like, I don't really know what's really to touch, that's why Stash recommends your portfolio ETF all the time, is because it gives you that diversity. Basically, from my understanding is that you could own basically that specific portfolio profile ETF, and you wouldn't really need to go buy any other things. Like, that could pretty much be your entire core holding or your entire portfolio, and you wouldn't really need exposure to any other market, because that would be pretty much all you ever need. So anyways, I hope that helps you out there, Julian. If you do have any further questions, I would love to see them down in the comments. If you guys have any questions in regards to it on the live stream, I'm looking at it right now. But anyways, feel free to let me know your thoughts. I would love to hear them. I'd love to see them in the chat or even in the comments. But it's been real, guys. Thank you for watching. I really appreciate it, and I will see you all tomorrow. No, that's not gonna work, because I ended it like it was like the live stream. Anyways, guys, thank you for watching. It's been real. I really appreciate it. Peace out.